Hello, hello, and welcome to the third quarter review and market outlook for the remainder of 2025. My name is Austin Fitch, and I am joined today by the Horizon Investment CIO, Scott Ladner, and excited to get into the conversation. For those of you that are new to this conversation, every quarter we get together with Scott and we go through what Horizon's seeing in the markets. We review what has happened, and we also take a look at what is going to happen, or what we think is going to happen, I should say, over the next 3, 6, 9, 12 months from a market perspective and from an economy perspective. So excited to get into that conversation. Really excited to dive in today. We've got a number of good topics that we're going to talk about today. As you can see, we're going to start off with basically where we sit today, but then we're going to walk through 3 different scenarios that we think could play out on a go-forward basis. Then we're going to talk at the very end about other market data points that maybe you should be looking at, or that we're looking at specifically, that give us some context and some color about where we think markets could go from here. So with that being said, we will jump right in. Don't hesitate to ask questions. If you have them, you can drop them in the chat box. We will try to get to as many of them as we can. We'll try to hit them along the way, but we will also take some time at the end, if we have it, to answer any questions there, if there are still any outstanding. And if we don't get to your questions, please, please, please don't hesitate to reach out to your Horizon contact, whether that's a regional director, whether that's a portfolio strategist, you name it. We're here to help and here to have these conversations because we love to get in front of advisors and have this conversation on a regular basis. So without any further ado, we will jump right in. And Scott, I'll bring you in here on the first slide. We jokingly say that it's always about the economy, quoting our friend James Carville. Maybe let's walk through this slide, what it means, what we think could happen, and maybe the context of this as we set up the rest of today's deck.
Yeah, and let me just kind of state right off the bat for those of the younger advisors that do not know who James Carville is, because it dawned on me when I was asking some of the marketing people to put some of this stuff together. I was like, put this picture in here, and then I asked her, I was like, do you know who this is? And she was like, I have no idea who that is. I just thought you were calling everybody stupid. I was like, that's a problem. So yes, no, we're not calling anybody stupid. It's just Carville's sort of catchphrase. And this one is I think fairly succinct. Like there's been I'm sure you've been inundated with data points and sort of analysis about like what happens after the Fed cuts, what happens after the Fed starts cutting again. Look, it's pretty simple, guys. Like this is always the case. The stock market does end up following the economy at some point. And it's not different when the Fed starts cutting. So if basically the beautiful Carolina blue line up there is it shows what happens to the stock market when there's no recession after the Fed starts cutting. Sort of that nasty kind of gray line down there is what happens if we go into recession, because of course going into recession, the stock market falls. And sort of the kind of gets not quite the Kentucky blue line there in the middle is sort of the average of everything. So but the upshot is just what we think it is. If the economy avoids recession, stock market does really well following Fed cuts for the next 6 to 12 months. And so that's that, like our base case is Carolina blue, and that is like we'll kind of walk through why. And there is risk to the other side. We're also going to walk through and exactly why. But we think this is setting up for a pretty nice next 12 months.
Awesome. No, I think that's a great primer, Scott, in terms of setting expectations. So what we're going to do is we're going to walk through 3 possible scenarios, right? The first possible scenario being this idea that we kind of muddle through. So think of it as kind of that middle, like you said, Scott, kind of darker blue line. Maybe things aren't great, but they're not terrible. So we'll walk through what that scenario could look like, how we get there, maybe market reactions there. Then we'll walk through that gray line. Hey, here's a scenario where possibly you do go into a recession. And then at the very end, we'll walk through kind of that growth booming scenario where, hey, maybe things are going really well, and here's how that would play out. So excited to go through those scenarios, and we'll talk through kind of where we think possibilities of each of those exist. But like I said, we're going to start with this kind of muddle through scenario and how we would get there and what that would potentially look like, maybe some data points that we should be looking at to get a sense of whether or not we're there. And Scott, let's start with the labor market, because I think we've been getting a lot of data points about, hiring has fallen off the map. Should we be worried? Is the labor market falling apart? Maybe walk us through what we're looking at here, but then let's talk just a little bit more broadly about labor markets and what that would mean in like a muddle through scenario.
Yeah, look, I mean, the muddle through is just we kind of get stasis. We like everything is kind of stuck, and I think that's sort of a kind of framework or analogy like fits today. It fits today's labor market. We're not seeing, this is just data about like how many people are being hired, how many people are being fired, and this is in particular on the higher side of things, but ultimately, like you can see, like where we're sitting, like we're just not a whole lot of hiring going on in the economy. And that's not typical of a vibrant, sort of expanding and kind of well-rounded economy. Like you want to see hiring, really strong, and that's really consistent typically with a robust economy. We're not seeing that right now. We're not seeing the hiring side of the labor market really be very robust. We're just kind of stuck. The thing that you expect to see in a crummy economy though is the firings go way up, and we're not seeing that either, guys. Like we don't have data or chart on that, but both the hiring and the firing rates right now in this U.S. economy are really, really low. And it just kind of points towards this kind of stuck labor market right now, where it's not necessarily dangerous, it's not good, it's not bad. We're just kind of like we're at a reasonably good employment rate right now, but overall we're kind of stuck, and it's like pointing towards sort of muddle through on the labor side.
So Scott, you mentioned kind of hirings relatively non-existent, but firings are also not increasing substantially. Interestingly enough, I think the breadth of the employment picture actually is maybe a little bit healthier than folks would otherwise expect, right?
Yeah, look, I mean, you do one way to assess the labor market is you do need to say, the big sort of numbers matter, like the national level numbers matter. But you also kind of need to see the breadth of things, and to the extent that you're seeing like a broadness in terms of like state level data, it's kind of industry level data. You want to see kind of a wide swath of type of information when you try to assess the overall health of the U.S. labor market. And right now, that's like the breadth information is frankly really good. These are just sort of breadth indicators of sort of employment stress. And you see like we started to get there a little bit. On this chart, on both charts actually, but we never really kind of got to the place in a sustained way where we had breadth of sort of labor market data that was concerning at all. And right now we're at levels that are wholly unconcerning on the labor market. So again, this isn't again a sign of necessary vibrancy, but it is it does lend some credence to the fact that the low hiring rate is not consistent with a really poor labor market.
No, that's a great point, Scott. And I think another thing, and we've talked about this in the past, is this concept that starting place matters, right? And right now you're looking at a chart of the percentage of the labor force facing continued unemployment. And if you look at this picture, right, it's hopefully a little bit of a no-brainer to be able to say this, that the labor market is not nearly as dire as maybe headlines would have you suggest, right? You can easily make the statement that the unemployment picture has gotten worse over the last 2, 3, 4 years. But if you look back over the last 35 years, I think you can also easily make the point that we're nowhere near where we were heading into a 2008 scenario, or even, with the spike that you saw in a 2020 scenario, right? Those end up off this chart. And right now what you've seen is a couple, tenths of a percentage point in rise in continued unemployment, which again goes back to this concept that starting place matters. And we joke sometimes internally that if you torture the data long enough, right, it'll confess to anything. You can easily make the case if you just look at percentage increase, right, Scott, that, hey, this number has gone up 20 to 30%. And it's like, well, that is true off the bottom. But what you're actually looking at is you went from, 0.8% to 1.1 or 1.2%. To look at the actual raw data, I think we can make the case that continued unemployment is nowhere near where you would expect it to be if you were heading into a recessionary scenario. Is that a fair assumption?
Yeah, look, I mean, it is absolutely the case where if you were a bear, you could have the data from this chart and you could say unemployment statistic rises 50% from lows. And that presages all sorts of doom and destruction and whatnot. And then you look at the chart, you're like, well, that's a dumb thing to say. I mean, it's a truth thing to say. It's also a dumb thing to say. Like both those things are true at the same time. I mean, look, you could spin this in a way that can be nasty. But if you just look at the picture says all the 1,000 words that you want to see.
Yep. Scott, one other area, if we talk about this muddle through scenario, is starting to look at the housing market. And I think we've heard a lot over the last few years about home prices and the fact that they're astronomically high, and maybe this is creating a problem. I think what we started to see is maybe they're actually trending down a little bit. So let's talk about maybe how that works into this muddle through scenario, maybe where it's a marginal positive, where it's a marginal negative. Like, what does that contribute to this overall picture?
Well, I mean, one point we're on the muddle through side, Austin, is just like there is no quick fix for the housing issue. Like we have a housing supply problem in the United States of America, and that there's no quick fix to this thing, guys. Unfortunately, we essentially got what I was trying to show with this chart is show that home prices do tend to go up through time. Like this, this goes back 40 years or something like that, and it's a fairly well established trend line that you can show like here's where home prices would be, like just kind of going through time in general. And this is at a national level. I know everything's local and real estate and all that kind of fun stuff, but just kind of pulling stuff back a little bit. The national level, like home prices tend to go up through time, and here's about where they'd be, like if we just kind of draw a stupid trend line through this stuff. And what generally obviously happened through COVID is we got like 7 years or 8 years worth of appreciation in the span of 12 months. So we kind of like pulled forward a whole bunch of appreciation in home prices that we probably would have otherwise gotten, but we just got it all at once, and it created all sorts of kind of issues. The point with this is like, this is healing itself. Like home prices are starting to come down, and if nothing else happens, just these these two trends sort of stay in place. Home prices in 18 months or so are going to be about where they would have otherwise been had COVID never happened. And so like this is kind of like a time will end up healing this to some extent. We're kind of solving this kind of problem, but on the muddle through side, like there's nothing that the government or really anything private can do to make this happen really quickly. And there's also nothing in this type of data that is suggestive of any sort of real kind of fundamental economic problem coming from home prices slowly and steadily declining over the last 3 years, because they're just kind of getting back to where they would have otherwise been had we not had that kind of COVID pull forward.
No, that's a great point, Scott. And I think does a pretty good job of like you said, kind of laying the groundwork for that being part of that muddle through scenario, and the fact that it's not a quick fix on one side or the other. Now, if we shift gears a little bit, and now we start to talk about this idea of growth going bust, right? Hey, here's a scenario, or here's how potentially things would play out in the event that we headed into some sort of recessionary environment. And first and foremost, let's hit on this idea of, people maybe attacking the Fed's independence. I think we can make the case, and we're doing it on this chart, that hasn't happened yet. That doesn't mean that it's completely off the table, right?
Yeah, I mean, the point of this chart again is it's not the two lines necessarily. The point of this chart is that like 10-year inflation expectations are right around 2%. 5-year inflation expectations are right around 2%. Like nothing's budged. And the thing that you would see, like absolutely, you would see this if the market decided that the Fed's independence was really at risk or really in play, longer term inflation expectations would go up. They would not be sitting around 2%. They'd be 3, 4, 5%, which would be very destabilizing. It would be like super bad. If Trump wants lower rates, attacking the Fed is the literally opposite thing you should be doing, or kind of attacking, bringing into question Fed independence, because the sort of the pricing mechanism that you're going to see in the market and in rates, if the Fed independence is really truly questioned, is higher long-term rates, not lower long-term rates. And that this has happened like multiple times through history. This is not open for conjecture. This is not this Scott thinks. This is like happened like 100 times over the last 50 years in different economies, not in the U.S. obviously, but in different economies. We know what the book says. Like we just don't want to read it. But this is not this. I guess this, for a growth buster kind of scenario, like if the market decides the Fed independence is really in play, longer term rates going up, and it go up through the expected inflation channel that we're showing here. Not happening yet.
Good. That's a great point to kind of start off that conversation, Scott. And now if we transition that into the consumer side of things, I think let's talk about the fact that so far consumer spending has been stubbornly resilient. I think this chart does a good job of showing data for this current year, which we know there's been lots of volatility from a market standpoint, from an economy standpoint, when it comes to what we've seen around tariffs and those conversations. But if you look at spending just so far this year, spending has continued to grow year over year positively, basically at any rolling 28th day or 1 month period, other than a couple blips that you saw early in the year. But you've seen a consumer that, because they've been, and we talked a little bit about it earlier, because they've been relatively fully employed and we haven't seen significant issues there, they've continued to spend, right? So that's, if we think about this growth buster scenario, okay, what happens in that scenario? Well, the consumer probably starts to get a little bit more cautious. They start to believe and behave maybe a little bit more, fearful. They maybe start to slow down from a spending standpoint. And I flip to this next slide because you're starting to see some preliminary data points that you would expect to see a lot more of if you really saw growth go bust, right? Maybe it's this idea that the tariff conversation really starts to weigh on consumer purchases, whether that's some of the items that you see here, like electronics, furniture, clothing, or healthcare, personal care, those types of things. If you start to see that spending component really start to take a hit, then I think then you're talking about this growth bust scenario. Scott, anything else you would add when it comes to like looking at the momentum and the trends that we're seeing in some of this spending data?
Yeah, look, I mean, the risk here that we're trying to point out is pretty clear that, if tariffs do end up impacting prices in a meaningful way, it will impact consumer behavior, consumer spending. Like, that's not like, we need the consumer to hold up, guys. Like that the economy needs the consumer to hold up. And so again, this is not our base case. But if some of these policies end up causing the consumer to change their behavior from an economic standpoint, from a spending standpoint, I mean, we are detecting some of that in sort of the directly, the good service, kind of goods places that are impacted by tariffs in different ways. That would be a challenge. That'd be a worry. Again, we're not seeing tons of it right now, but these are the things that are on our sort of our radar to be watching, and that we are watching to detect if things are going to turn in a way that we were not currently expecting.
And to be clear, Scott, some of this data that we're looking at is weekly data at this point. So we want to see these trends take place over a longer time period, not just 1 week's worth of data. Doesn't tell us the story, correct?
No, absolutely true.
Yep. All right. So if we think about what else could contribute to growth starting to go bust, we've talked a lot, and we'll actually talk a little bit more here in a few minutes about CapEx and specifically around the AI side of things. Scott, tell us kind of what we're looking at here in regards to technology capital expenditure and why that could potentially contribute to a slowdown.
Yeah, I mean, we are going to talk a lot more about both CapEx and AI CapEx. So like all the combinations of things, AI and CapEx, we're gonna talk about here in a minute. But one of the risks of AI becoming a dominant force in the U.S. and global economy is that more of there's more spending tied to it, and it's responsible for more and more of kind of growth and growth expectations. And so if the market decides that the spending on AI related CapEx, and building of data centers and sort of AI factories and whatnot, if they decide that this is a bad thing for companies to be doing, and that causes companies' behavior to slow down on this, that would be a drag on global growth. I mean, it would be a drag on U.S. growth. This is not, again, something that we have in the base case at all. But just as AI becomes a more important piece of the economy, changes in sort of both consumer and, more importantly, business behavior related to how AI is sort of coming into its own, it poses a larger and larger risk. And so we got to keep it on the radar.
Absolutely. So, Scott, if we're able to put a bow on just kind of the growth going bust scenario, I think the simple way to make that case is if the labor market cracks, the consumer cracks, ultimately that leads to the economy more broadly starting to show cracks. We're looking at a couple data sets here right on the left. If we're looking at payrolls and growth of payrolls, you'll note that we continue to see payroll growth, at or near pre-pandemic averages, about 5%. If you're looking at payroll growth over time. That being said, again, starting to look at maybe some shorter term trends, you start to see those falling off a little bit. So, Scott, maybe that's another data point that's worth looking at, and just, again, having in the back of our mind, knowing that if this is the linchpin, the labor market, the consumer, like this is some of the data that we should be paying attention to. Is that right?
Yeah, I mean, again, just to refresh folks, because I know that they've seen we've showed these data before, but when the thing we're calling total payrolls is just the number of people working times how many hours are they working times what are they getting paid. And so it's, you can think about it just like the spending war chest for the U.S. consumers, like in terms of like spending, consumer spending based on income. And what we've seen in the last couple 3 months is it's slowed down. It has slowed down in the past. This is a somewhat volatile series. But like watching these things, this is one of the things we're watching like a hawk, because the labor market and consumer spending is as you said earlier, Austin, like it is the linchpin for a lot of our analysis. And so I wouldn't say we're concerned about this yet. This is one of the things we're looking at, but we see another couple 3 months like this. It will definitely have our attention.
Awesome. All right. So we've walked through kind of the muddle through scenario. Now we talked like, hey, here's what it would look like if growth goes bust. Okay, now let's talk about that scenario where maybe growth starts to boom. And Scott, I feel like we have touched on this time and time again. It's the AI conversation, right? The productivity, the scalability conversation. We're going to talk a little bit, and we're going to show a video here about maybe another example of how folks can integrate or how folks should be thinking about integrating AI. And I think what's interesting, right, is, Scott, we've talked a lot about this concept that AI possibly replaces or augments kind of white collar jobs, right? Your mental side of thing from a mental labor perspective. Now we're going to show you a video of maybe some physical labor help that AI is going to start to be incorporated into, and some of the productivity gains that you would potentially see there. Scott, anything else we should be looking at before I hit play on this video?
Yeah, I mean, you stated it pretty well, Austin. I just want to make sure that everybody watching this understands this. These are actually two different videos that we spliced together. Basically the first half is about 2 minutes in total. First minute or so is more on the manual labor side, just like an example of something that I think is pretty cool. And interesting, like the advancements that we're making are on sort of the the kind of the agentic side of AI, and be able to replace or augment manual labor and drive productivity growth that way is pretty cool. It's just an example of that. And then the second half of this video is more about the physical sort of embodiment of AI. And I think the physical sort of robotics side of things, in terms of AI having to be able to drive the behavior of bots and whatnot, in the physical space, and the ability for that to really impact like the physical labor side of things. I don't think people are really taking full kind of advantage, or not advantage of it. I don't think I have the really good vision into that right now. And so I just want to provide a little bit of context and like a preview of what's coming to your world in the next 12 months.
Awesome. All right, here we go on that.
Hey, go online and look for a user's manual for a Huffy mountain bike.
I have found a user manual for you. What would you like to know about it?
Okay, cool. Now scroll until you find the section about the brakes.
Sure thing. Looking for that page now.
I think I stripped this screw. Can you go on YouTube and find a video for how to fix that?
Of course. I'm opening YouTube now. This looks like a good video.
Place a rubber band over the head of the screw.
Oh, nice.
Press down
Thanks.
firmly.
Can you go through my emails with the bike shop and find which size hex nut I need?
Sure. According to the email from Bicycle Habitat, you need a 3/8" hex nut for your sprocket. I've highlighted the correct bin for you.
It seems like I need a spare tension screw. Can you call the nearest bike shop and see what they have in stock?
Yep. Calling them now. I'll get back to you with what they have in stock.
Hey Neo, can you hand me my beer?
Doing chores requires that you can take commands, move around the house, and manipulate things to complete tasks. Redwood is a multimodal AI that merges together language control, locomotion, and whole-body manipulation into a single neural network that is both seamless and scalable to all kinds of tasks. Redwood isn't limited to the exact objects and locations seen in the training data. It actually generalizes to new positions of the objects being grasped. It is also able to pick up a bottle it hasn't seen before during training. By controlling Neo's entire body, Redwood makes it possible for Neo to bend over to reach a far object, or to perform multi-contact actions like opening a door. Whole body manipulation really broadens the scope of chores that Neo can do in the home, such as squatting down to put clothes in the laundry machine. Redwood is still early in development. It doesn't always succeed on the first try. But failure data is really important for improving the model because it teaches the AI what not to do. By deploying Neos in homes like this one, and learning from all these multimodal interactions with physical reality, we'll be making an AI that is smarter, friendlier, and safer.
All right, Scott. So we've now looked at potential use cases, right, for AI as it in regards to the physical labor side of things. If we're envisioning that, or if we're seeing where that potentially goes in the future, now let's go back to that AI CapEx conversation, and let's take a look at, okay, so what type of investment should we expect to see from an infrastructure standpoint?
Yeah, and it's massive, right? I mean, like this is on par or exceeding sort of the infrastructure buildup that we did to basically make the internet go everywhere in the world, and in the late '90s, and it is dwarfed by the infrastructure project that was the railroad system in the 1880s. But this is, I'm just trying to put some context around, like, this is a big deal. The AI infrastructure and the data center and the AI factories and everything having to do with sort of making the world AIable is increasingly a large part of the economy, and we do think of it kind of like a private sector stimulus package. Like instead of a government stimulus package, this spending on AI data center, like on AI infrastructure writ large, is very much like, has a lot of characteristics of a what would otherwise be just known as a stimulus package. It just happens to be generated from the private sector.
Yep. All right, Scott. So again, we're thinking about growth going boom, right? Things going really, really well. Should we be worried though of tech taking all of our jobs, right? And the economy changing dramatically, and we're all out of work, and all of a sudden we've got a labor market issue?
Yeah, look, this has been a worry for a very long time. 3 out of the 4 people on this chart are smart people. The other one, not so much, but it is what it is. Like this has been a fear for a long time. It never pans out. Technology does not destroy jobs. Technology brings improves living standards, and it increases jobs. It changes jobs. Like, nobody's going to argue that the same jobs are going to exist in 100 years or 50 years or 10 years that do today. But the idea that technology, like AI, is going to come and take everybody's job away and nobody's going to have anything to do is just, it ain't new. People have been worried about this for a long time, and every single time they worried about it, they're wrong. They're going to be wrong this time too.
Awesome. No, I think that's great context and good for people to at least have in the back of their mind. So Scott, we've talked about the AI side of things. We've talked about the CapEx component of that. And I think that's extremely important to think about when it comes to CapEx, because the most recent tax bill, or the big beautiful bill, as some would like to refer to it as, is effectively going to drive down, or have the ability to drive down, the effective corporate tax rate significantly lower than it is today, and potentially as low as anything that we've seen in the last 40 to 50 years. Scott, if that's the case, from a CapEx standpoint, it really only helps kind of this growth case that we're talking about, right?
It does. And look, I think this is really underappreciated. This is not in the price, guys. Like, this is not in the market. Now, to be clear, that like this driving the effective tax rate down 10% is an assumption laden sort of practice, and we have to make some sort of assumption about how much capital expenditure our company is going to engage in, and then thereby take advantage of the expensing aspects of the big beautiful bill, and that so like we don't know what this number is going to be, but the effective tax rate for U.S. corporations is going down. We don't know exactly where it's going to end up. We think it's going to be actually, around this. We think the assumptions embedded in this analysis are in the neighborhood of right. But we'll market to market through time. But directionally, U.S. corporate tax rates are going down, and going down in a meaningful way. That is not in the price. People are not talking about this right now. And we think it's one of the important drivers really for 2026.
And couple that with this CapEx conversation, and it's honestly not just AI CapEx. It's really CapEx across the board. Scott, I think this surprised me the first time we looked at these charts, just the age of many of the structures that exist, whether it's manufacturing, whether it's just standard industrial equipment, whether it's some of the mining stuff that we see there on the right-hand side. Like, you're talking about decades worth of buildup of the age of many of these pieces of equipment or these structures. Like, the ability to replace these in an environment where you're incentivizing that CapEx piece actually could be, as you talk about kind of the stimulus package. Like, you're really looking at that possibility over the next 2, 3, 4 years if we're thinking about it right.
Yeah, I mean, look, we don't know how companies are going to each individually respond or respond as a group. But what I can tell you for certain is the setup's there. Like the incentive structure is correct in terms of like the CapEx being now deductible, fully expensable, like all at once. The incentive setup is there. The sort of the fundamental underlying setup is there because we got a lot of old stuff to replace. And so it's like the setup's there. I don't know what's going to happen. We think it's going to happen, but I know for certain that we have the right setup.
Yep. No, makes sense. Okay, so if we're talking about the tariff conversation, let's go back there because I think some folks have been concerned, and rightfully so, that maybe the tariffs weigh on this growth conversation that we're having. Let's talk about hey, who's paying for the tariffs currently? Why hasn't or why won't it weigh on growth? And if not, who's paying that cost? Scott, maybe walk us through these two charts and what we're seeing so far from a tariff standpoint.
Yeah, I mean, look, the question, even who's paying the tariffs, obviously just sounds like a politically loaded kind of question, and depending on who's answering it, they're going to have a yarn to spin for something. Like, I don't really care about any of that stuff, guys. I'm just trying to share, like, there is a part of the tariff, sort of the tariff, kind of tax that can be paid for through productivity gains. And we are starting to see some of that. I mean, the corporate profits have exploded since COVID. Margins have exploded since COVID. Part of a lot of different reasons for all this stuff, but AI is at the center of at least some of it. And so to the extent that corporates can end up sort of stomaching some of this, some of these increases costs, like input costs, because of the tariff situation, it's a rational position to take. And so, like, there's no easy, simple answer for who pays the tariff, like who eats it. I don't really care who eats it. I mean, like, this is an idea that so the productivity gains we've seen over the last few years, and we're going to see even more rapidly over the coming few years, gives corporations the ability to take some of it on and not really suffer that dramatically by it.
No, makes a ton of sense. All right, Scott, we've talked about a lot when it comes to the growth picture. Let's go back to the consumer though. And hey, we've talked about this concept that the consumer is the linchpin. And I think one thing that we got to make sure that we recognize too is that if we take a step back, that the U.S. consumer still sitting flush when it comes to cash, money markets, bank accounts, checking deposits or checking balances. Like, if you look at this chart, the bigger chart there, you can get a sense of how much cash was built up during that COVID scenario. And we do the little call out box there because we've gotten the question in the past. So isn't that just kind of the ultra high net worth folks that are stockpiling money? The chart that's in the call out box there actually looks at the bottom 50% of household net worth and paints, I would say, honestly, maybe an even more dramatic picture of the stockpiling of liquidity and flushness of cash that exists in that consumer pocket today, which I think paints a pretty good picture of consumer strength. Now, again, we've highlighted some of the potential risks that could come down the pike, but as it sits today, the consumer's in a really good spot, which then, Scott, I think does a good, maybe sets the backdrop for this fact that we're not really seeing any stress from a consumer standpoint right now. Is that correct?
No, yeah, we're not. I mean, like, it is. What was not in that chart before also that should at least be mentioned is home equity. Home equity is through the roof also. So, like, when you take that, I didn't even put that in account because that's not really liquid. But we were talking about, like, checking accounts, savings accounts, money market accounts, like stuff you can get tomorrow. But if you kind of come down to is a consumer stressed out standpoint, are they missing payments? Like, one of the first things you do if you start getting stressed is start getting late on your credit cards. And so this is JP Morgan data. JP Morgan is, it serves as a wide swath of credit cards that's touching a wide swath of the sort of the consumer base in the United States. And these are, just look at some of these delinquency rates. I mean, there's just nothing here, guys. There's nothing to look at. Like, we are like, you see some of the GFC era data, see some of the pre-GFC era data, and just look at the last, then you see some of the pre-COVID stuff. Just look where delinquency rates are now versus any of these types of periods, and like we're like what are we saying? Like, what are we doing here? Like, why are we talking about consumer stress when it's not showing up in literally any data that I can find anywhere in the world that is meaningful? So like, I'm not saying that it can't happen. I am saying it is not happening today. And so like, we're watching it. We're going to continue watching it. But it is just not in the data set right now.
Nope. I think that's super important to highlight. And Scott, I would say, if folks didn't have any idea who James Carville is, they probably equally have no idea who Jim Mora is.
Yeah, I'm showing my age with all this stuff.
That's a whole different conversation.
Is what it is.
All right, last piece in the growth kind of going boom scenario is, hey, we've heard all this talk about consumers being pessimistic, or they're stressed out, or they're depressed, and they're not doing X, Y, and Z. Kind of flies in the face of what we're seeing activity wise, Scott, from a business application standpoint, right?
Yeah, I mean, you just said it. Like, I mean, I think the title of this one sort of says it all. Like, watch what people do, not what they say. Like, there's a lot of business formation going on in the United States right now. That is something that happens when people are optimistic, not fundamentally pessimistic. So, you know, survey results are saying that everybody's really kind of down in the dumps, but down in the dumps people don't start businesses.
There you go. We'll leave it there. All right, so we've outlined 3 different scenarios. Scott, you said it at the beginning, kind of our base case is this growth continues to boom scenario. That being said, there are a lot of things that we're watching for from a data standpoint. We now have a few slides that'll maybe paint that picture even a little bit more around, hey, here are some things, data points that we think will continue to add value, but also give you a sense of potentially which scenario or which path we're going down. One thing, though, that we continue to hear time and time again is, hey, the markets can't go higher. They're massively overvalued, right? This is a survey from Bank of America Merrill Lynch that looks at fund managers around the world. And you can see over the last almost 30 years worth of data, the percentage of fund managers saying that equity markets are overvalued is near, actually probably at an all-time high. As of the most recent reading, I think paints a pretty dire picture in terms of equity markets, path from here. That being said, Scott, I think a lot of this actually comes from some data that we would push back on, and maybe in some cases push back pretty hard on, right?
Yeah, look, if I never hear CAPE ratio again, those words, it will be too soon. This thing is just the worst. The worst of financial engineering, the worst of sort of valuation metrics. I understand what it's trying to do. I'm not saying Robert Shiller's a dumb guy. Like, he's obviously not. But I think this just gets distorted and talked about far too much for the value that it actually possesses. It possesses almost zero value for managing money. It possesses zero value for actually figuring out what to do from an investment standpoint. And then the reason is because we're just using really old data, valuation data, to figure out what the stock market's really valued today. It's a stupid exercise. And so if you were to look at not trailing 10 years, but forward 10 years, sort of numbers, that's the blue line. Like, again, what are we doing here? Like, what are we talking about? Like this is an overvalued market when we're on the cusp of a technology and another industrial revolution that is centered on AI. Like why are we having these valuation conversations based on a ratio that is flawed, very fundamentally flawed in its construction, and even more flawed in its interpretation? It's just silly.
We'll put you down as neutral, Scott. I think we've got a sense. All right, but if we move though, Scott, to comparisons, you mentioned it, right? Okay. Hey, should we be comparing this to what time period historically? I think we've made the case previously. The 90s, we think, are still a pretty good comparison from a valuation standpoint. Yeah,
I mean, look, the first thing you should see about this chart is that the relation. So this is just a scatter chart of, in different decades over the last 75 to 80 years of trailing price earnings ratios and the next year's performance. So like at least as a shorter term measure of valuation, and is valuation predictive of next year's performance? And the first thing you should notice about this thing is it looks like a brick. Like, so the scatter plot is a brick. Anytime a scatter plot looks like a brick, that means there's no relationship between the two things that you're purporting to have a relationship about. The R squared of 0.04. So the line goes like almost flat. I mean, this is a silly thing to be talking about. But if we're going to talk about it, at least talk about it in the right context, and if we can map the right comparison set. The right comparison set to this decade is the 1990s. And if you look, like the top right quadrant of this thing is like basically dominated by this decade, and then in the 1990s. And we think that actually makes like a little bit of sense. Like this is the right sort of kind of fundamental underlying backdrop from an economic standpoint, and from a productivity growth standpoint, and from an earnings growth standpoint that we've got. It's the best comparison that we've got in the data set, and it's sort of coming through. Even though, please don't ever use valuations to trade your stock portfolio. Period.
All right. So if we're talking, we've talked about valuations. Now let's take a step back and let's look at, hey, what's actually driving growth, right? Is it growth of earnings, or is it multiple expansion? Going back to that valuation piece, I think what's super interesting, Scott, is if we look at the data for calendar year 2025, we've highlighted the technology sector there in yellow, but I would encourage folks to look just one line below. And so far this year, the S&P 500, right, is up roughly 10%. What you've seen is about 2/3 of that has actually come from earnings growth, and about 1/3 of it's come from multiple expansion, right? And a lot of people are going to say, oh, but it's tech that's driving all of the S&P 500, which there's some truth to that, right? A lot of the tech stocks, the Mag 7 names that we've talked about previously, are driving some of the growth that we've seen in the S&P 500, the price return that we've seen. But if you actually look at that technology line, you'll actually note that over 100% of the price return that we've seen so far has come from the earnings side of things. So earnings are actually driving the growth. You've actually seen a multiple reduction from a technology sector standpoint. So super interesting. Again, if we're talking valuations, if we're talking multiples, I think it's super interesting to keep in the back of your head. We're not just seeing multiple expansion. Actually, we're in some cases, the more overvalued, and I'll put quotes around that side of the market, is actually coming from earnings growth and not multiple expansion at all, which I think is super interesting to think about as you start to think about, okay, maybe what causes this to continue to run from a market standpoint. Scott, another thing that we've talked about is this concept of, hey, if we expect the market to continue to run, we're going to need the market breadth to increase, and you're finally starting to see that a little bit.
Yeah, I mean, hallelujah, hallelujah. Look, Mag 7 stuff notwithstanding, and we obviously love AI, kind of the AI theme, and we love the tech side of things for a lot of different reasons. But man, is it boring to have the Mag 7 lead everything all the time. And so what we've really been hoping for, and we've been looking, like trying to see if we can find it, is like, can we get the rest of the market to really kind of catch up in terms of like having earnings growth again, like really getting that inflection point of getting earnings growth going higher. And hallelujah, it looks like we're starting to get it. And so there's just the median, like the median, Russell 3000 stocks, big, mid, and small. And like we're just finally starting to get out of this trough of kind of earnings trough, like basically earnings recession we had for the median stock during 22 and 23. We're coming out of it, and it looks like we're finally starting to get some kind of momentum to the upside in terms of median growth. That is what you have to see for this market to broaden out, for the Mag 7 not to lead everything around by the nose. That would be like super helpful for a lot of things. Be far more interesting place to live. But for the market to continue higher and like have another great year next year, like we're going to need this market to broaden out, and that's because it can't. That's what has to happen. It looks like it's starting to happen. We're not there yet, but it is. We are seeing these nice slow green shoots that are giving us a little bit of hope in that direction.
Awesome. So Scott, you mentioned kind of, hey, what do we see going forward, and maybe the breadth being something that kind of has to be there for us to see that next step. Let's have the conversation about rates. What do rates have to do, and where do we see rates today, and what does that mean on a go forward basis?
Yeah, I mean, part of the point of this chart was just to show, like, like our rates, our 10-year rates, we'll call 10-year rates long-term rates. Our long-term rates in the United States, right. I mean, like, are they on the right level? And rates tend to be anchored somewhat by nominal GDP, and so this is just 10-year rate relative to nominal GDP in the United States. And right now, basically, we're kind of right on top of it. And so, like, that's telling you that we don't really have either easy nor restrictive sort of monetary policy or kind of rate, like a rate setup for the economy. And that's just going to tell you that your yield on your return on your bond portfolio is going to be the yield on your bond portfolio for the next several years. And so for an investment grade bond portfolio, you're going to talk about 4 or 5% is kind of what you're going to get in bonds, and there's not much you can do about it. Like that's going to be the return, because like rates today are in a neighborhood of right.
So Scott, if that's the case, right, if rates today are in that neighborhood of right, then let's have this conversation about the connection between stocks and bonds, right? We've seen for probably the last couple years that you've had a positive correlation, but prior to that, for a long period of time, there was a negative correlation. So let's talk through maybe why that happens, but also we've got a couple slides here on maybe what we should expect going forward.
Yeah, I mean, and this is important. Like, this is one of the most important things I think we're going to talk about today, and it's something that we've talked about before. I mean, if you've been listening to us for a couple of years, we have brought up this point before. But if the biggest risk to the economy is inflation, you get the red box. You get stocks and bonds that move together. That means a 60-40 portfolio doesn't work. That means your bond portfolio will not hedge your stock part of your portfolio. They will move in tandem. That phenomenon, the 60-40 portfolio being sort of the max Sharpe ratio thing, and where bonds hedge stocks, is really just a phenomenon that existed from the dot-com bust to basically COVID. But from the unique defining characteristic of the dot-com from basically 2000 to 2021 was that deflation was the primary risk to the economy. When deflation is the primary risk to the economy, then the Fed is basically all powerful, and they don't react to growth scares, and that means that basically bonds will hedge stocks at the end of the day, and that's this period in kind of in the green box. So I just think people think that's the norm, and it's absolutely, if we go to the next chart, like this is 50 years worth of data, it's not very much. Here's 120 years worth of data, which is a little bit more, and like just please like put this in your head as at least. If you don't believe me, at least put it in your head as a possibility. 2022 is the norm. The stock bond relationship in 2022 is the more typical stock bond relationship. And remember in 2022, people got all flummoxed because like my bond portfolio is not helping. Like my bond portfolio is down and my stock portfolio is down. Like what's going on? Why is kind of risk parity not work? Why is my 60-40 not working? That's the norm, guys. Because when 2022, inflation was the big risk to the economy. When that's the case, stocks and bonds move together. Like why would you expect something to move together to protect you? And so like that is most of recorded history. Inflation has been a bigger risk to the economy than deflation has been. Now you can decide for yourself what you think the more important or salient risk to the economy is on the go forward from here. If you think it's inflation, then I would strongly suggest that that don't count on bonds to hedge your stock portfolio or to reduce risk. If you think that the primary risk to the economy is deflation, then that should work out fine for you. But that's, please understand what the setup is and what the likely behavior of your portfolio is going to be. And it has to do with what the biggest risk in the economy is. Is it inflation or deflation?
Well, and that kind of goes hand in hand, Scott, with the next slide here. And a couple things to take away from this and to build on what you just said. I think it has become pretty obvious if we look at inflation expectations. Deflation is nowhere kind of in the cards in terms of expectations, right? You can see what we've seen over the last 4 or 5 years. You saw a bump up in inflation expectations, both on the short and kind of medium term, the 1 year and the 3 year. That being said, right, as we sit today, inflation expectations are really anchored back to where they were, maybe even a little bit higher than where they were pre-COVID, which I think, to your point, Scott, kind of says that stock bond relationship, the deflation conversation is probably not in the cards, probably not on the table, unless you get some sort of massive growth scare, if we talk about kind of that growth going bust scenario. Now, that being said, with inflation expectations being anchored, being a high level or a higher degree of certainty or expectations being more consistent, I do think it has given the Fed, right, the green light to start to cut rates. And Scott, we've seen that over the last couple quarters now, that we're starting to see some Fed activity that we also think maybe serves as a tailwind for the market more broadly. Anything else you would add when it comes to the inflation and Fed cut conversation?
I mean, I think you said it well, Austin. I mean, just that this kind of anchoring of inflation expectations for consumers is basically a green light for the Fed to cut. Whether you think they should or not, like fully irrelevant. Like whether I think they should or not, fully irrelevant. This, like their models and the way that they're thinking of the world, like this is a green light, guys.
And if it's a green light, Scott, let's tie it back into kind of the cash on the sidelines, the liquidity piece that we talked about earlier. Maybe some of this cash comes back into the market, right?
Yeah, I mean, it certainly could. I mean, like, so the chart on the left is just relates, compares basically the yield you can get on a basket of dividend stocks, or versus money markets. And so when it's green, that means that you basically make more on your money market than you do on a dividend basket of stocks, yield wise. And the right side is just like how much money are in retail. This is retail, retail money market assets, not institutional, just retail money market assets. A little over $7 trillion in there right now. I would suggest that as the Fed, continues to cut, and that basically the yield differential between basically money markets and stocks kind of converges or goes back in the favor of basically a dividend basket of stocks again. You're probably going to see some of this cash that is sitting in money markets come back into the market. And there's been a lot of talk about bubbles out there, like maybe cash is the bubble. maybe the money market thing is where the bubble is, not where everybody's sort of looking at it right now. And if that's the case, look, $7 trillion is a lot of money to come back in the market. I mean, obviously all wouldn't come out back in, but that's the marginal buyer. Again, this don't know what people are going to end up doing, but the setup is there.
Yep. All right, last slide, Scott. If we talk about the setup being there, we talked about fundamentals. Then the question is, okay, so where are we in this cycle? Where, what inning are we in the game? What should we expect? How much longer? Like, those are the questions that you're going to start to get. And I think this chart does a pretty good job of showing, relative to historical bull markets, I think you can make the case that there's still maybe a lot of room for this thing to run. Am I seeing that correctly?
Yeah, I mean, look, if the right comparison for us is the 1990s, I mean, like the best line to look at is the dark blue one that goes the longest. I'm not saying we're gonna have a 23-year bull market here, guys. Like, that's not the Scott Ladner call on in October of 2025. But I am here to say, like this is, like, put this in context. Like, this is not a very old one. Talk about late cycle, or talk about like a deep, long in the tooth bull market. That I've heard a little bit about is frankly, it's a little bit silly. I don't get it. But just on some of the numbers, this could have quite a lot more to go. And I think the setup again for it from a fundamental standpoint, from a what's driving it standpoint, as being sustainable earnings growth driven by productivity increases and productivity gains. It's a good setup.
Yep. No, Scott, I think that makes the point there as we wrap things up around everything that we've talked about today, right? This idea that, hey, history suggests that there are a few different paths that we could potentially go. From here, we walk through those three paths, right? This muddle along scenario. We walk through growth going bust. We walk through growth continuing to boom. And then we made the case at the end for, hey, given where we sit today, the fundamentals remain strong. Inflation's seemingly under control. Valuations maybe aren't nearly as stretched as folks would have you believe. Maybe we're in a pretty good spot from what it looks like today. Now, that being said, and Scott, you caveated this a handful of times as well, is obviously things can change. And the data that we're looking at is the data that we have today. So we're paying close attention to a number of different data points to see how they change. But with what we know today, we do think there could be kind of some room to run. Scott, let me ask, maybe there's been a couple questions that we didn't touch on that have come over, and then we'll wrap everything up. Really, the main one is, okay, given these three different scenarios, how do you think about asset allocation in a muddle through scenario? How does that change in a growth going bust scenario? How does that change in a growth booming scenario? How do you change a portfolio in those three different scenarios?
Well, look, I mean, you have to have some flexibility. In the muddle through, you're gonna want to think, like have a higher allocation to things like staples and more of the defensive side of the world, because that means growth will sort of mechanically slow down, and that's and the risk of a mistake from there would be higher, and the risk of an inflation of a recession there would be higher, just because you don't have as much sort of kind of room, like margin for safety or margin for error. In the growth bust scenarios, like fairly obvious, you want protection strategies. Like how are you gonna skin that cat? Whether you like option strategies or kind of things like risk assist or tactical strategies, low vol stuff, like whatever it is, You're going to probably want to have different ways to skin the risk mitigation cat in the growth bust scenario. And the growth boom scenario, like obviously you just want to like load up, guys. I mean, like get on the train and load up. This is I think going to be a pretty fun ride here still for a while. We're not anywhere near like bubble territory or sort of euphoric behavior, either from an investor or an economy standpoint. Just you basically want to have as much equity as you can get. And if it's a place where you need, you need to have sort of a buffer, like some protection in place in order to increase the base equity allocation, then that would probably be a preferred way to attack that problem.
No, makes a ton of sense, Scott. Really appreciate you joining us today, and thanks everybody for listening in. Always happy to have these conversations. Excited as we head into the last quarter of 2025 for where the markets could take us, but also the ability to continue to serve each and every one of you. If you have any additional questions, I would say don't hesitate to reach out. Again, whether that's to somebody on our sales team, whether that's to a portfolio strategist that you work with. Any way to get in contact with Horizon, we're happy to have those conversations. I would also encourage you to head to our website and our dashboard. For those of you that haven't been there or haven't been back in a while, please make sure that you're checking out those tools, because we continue to expand the availability of those tools and ways that they can hopefully help you with your clients when it comes to putting a portfolio in front of them that can help them solve for their goals. So excited about that. Excited, like I said, about the last 3 months of the year, and excited to continue to serve each and every one of you. So with that being said, we will wrap it up for today, but look forward to talking to everybody here soon. Thanks so much.